Hi, everyone. Thank you for joining us today. And I'm joined today by my good friend, Obi. Obi is a fund manager behind one of the key equity stocks that we hold here at Levantine in our portfolios. And I'm very happy he's put aside the time to join us today. Hi, Obi.
Hi, thanks for having me.
It's a pleasure. It's good to chat and discuss the fund. I think this is really exciting because the Carmignac is one of the fund manager firms that I've always liked working with, even when I was on the sell side. And I think there's a unique story behind the global equity compounder fund that you manage. So I thought it'd be good to start right there and say, really, can you explain about Carmignac, yourself, and the fund?
Yeah, sure. And look, we've got plenty of time, so hopefully we'll get through the fund. We'll come up with a few ideas of what we
Yeah,
think is happening in the world as well. But I mean, I've got a very similar story to yours. I mean, I was on the sell side up until 2014. I spent 7 years at Bank of America, Merrill Lynch as an equity strategist, and so back then my focus and my role was basically to advise fund managers like myself today
yeah.
on the big difficulty of sort of asset allocation. How do you put your money or your life savings to work so that when you retire 20 or 30 years down the road, you've grown your wealth. And so that was my goal before I joined Carmignac. But I knew of Carmignac as an investment house through my sell side work as well. And Carmignac is a French asset manager. I say we're French, as in we're based over in France. We've been around for 30 years. It's a family business that's run by Edouard Carmignac and his daughter Maxime Carmignac. But actually, the vast majority of the people that I work with on a day-to-day basis, that is the investment team of equity analysts, fixed income analysts, are broadly based around Europe. So I'm in our UK office today, and just upstairs, a floor up from where I am right now, is our team of equity analysts, which is pretty much the majority of our equity team is based here. And
When I
just to
used
give
to
you,
work with them on the sell side, they used to be out of Paris, and you guys used to have a great office in Paris. It was like a beautiful townhouse on the corner or looking onto a park, and it always stuck with me. So sorry.
yeah, no, I mean it's a great office, and we've got a fabulous office here in London. I mean, I think we're slightly different, and it's been great to work with you guys because I think we have a very similar ethos. We're not a one of the big names out there. And I mentioned that I
Hmm.
worked at Merrill Lynch, Bank of America, this big, massive institution. But Carmignac, we have just over 300 or so employees. So compared to the average investment house on the street, we're relatively small.
Yeah.
And in terms of assets under management, we're approximately 32 to 33 billion euros in total assets. So, we tend to be what I guess, some would call more of a boutique or a
Yeah.
niche player. But if you look at the team of people that I have sat around me, we're all from all sorts of different places. So myself from Carmignac, my co-manager Mark Denham, who runs the fund together with me, used to be at Aviva. He's one of their top fund managers for many, many years before he also joined Carmignac. So we have quite a diverse set of people that are based here now, even though it's an institution that you would call a French institution.
And could you tell me a little bit about the fund you manage? Because it seems to have quite a unique strategy. And if you could tell what sets the equity compounders fund apart from, let's say, a regular equity fund.
Yeah, and I think it's a good starting point. I mean, we put together this fund, the start of the process about five years ago. So one of the advantages of being a bit later to the game, especially in the global equity landscape, so it's a global equity fund. One of the advantages is you can look at all the problems that everybody else has suffered and faced and try and deal with them from the very beginning. And so
Mhm.
let me just talk a little bit about my own personal experience, and you can see how it fitted in with this fund.
Yeah.
Um, I've always wanted to invest. We have a system in the UK where you can put money into tax efficient vehicles, whether it's
Yeah.
instant savings or your pensions and so on. I've always wanted to invest in equities, and I've always found it very, very difficult to find a fund that met certain criteria. So one of them very simple things that that means a lot to me is it has to be a fund has to be long-term in its focus. And that's important because I want to understand what type of returns the fund's likely to give. And I'm sure on your side, when you're trying to put a package together of an equity fund, a fixed income fund, and other different asset classes, it's important to know what the return profile is like. So we'll come on to that in a second. But the primary objective was trying to find something that which is long-term focused. How we do that, we'll go on to. The second is, whilst you can think about the long term as in, the next 10 to 20 years and so on, we do also have to respect the fact that within the shorter term environment, things can change. So there will be periods, and we saw a little bit of that last year, where certain types of asset classes will do very, very well and some will do quite poorly. And so even within equities, there's a divergence between the type of companies that we would typically like to look to own in the long term. And that's what we refer to as sort of a macro. And we'll maybe go into that in a bit more detail. So I have to have something that would respect the macro. And then the final piece, or the third piece of the jigsaw, so one of them is make sure it's long-term. Second is understanding this sort of macro environment. But the third piece is one of the disadvantages of investing in just mainstream funds that are out there is they tend to be very focused on what we call the benchmark, which is making sure they're allocating stocks within their funds relative to a set benchmark of companies, whether it's the S&P 500, the biggest market in the US, or the Euro stocks in Europe,
or an MSCI index,
or an MSCI index. And one of the problems with that is that also naturally forces you to buy into certain parts of the market that we don't think are right necessarily from a fundamental perspective, but actually from an ethical perspective, we also don't think it's the right thing to do. Can
I interrupt you there, because I'm terrible with forgetting things. You touched on two really important points, and it would be great to hear it from you. Is when companies are daily traded, so when your asset is priced daily, especially last year was an excellent example. So markets are extremely volatile, equity markets. And there seems to be from investors sometimes a misconception between market price and what a long-term investment is. So is there anything you'd like to say on that? If I've been able to put the question correctly.
I guess what do we refer to that as? I would generally refer to that as volatility as in the movement up and down in share prices.
Yeah.
I mean, if you think about it, a company reports its filings or its numbers on maybe a quarterly basis, so 4 times a year, or maybe semi-annual basis. So logically, it doesn't make any sense that the share price would go up and down within a given day or even within a given quarter. So that's what I would refer to as volatility, which is this sort of daily movements of somebody saying, I want to allocate more money to this, and somebody else saying, I want to allocate less. I put that into the sort of the banana skin type of investing, which is, if you're worried about that short term or very short term, it's very, very difficult to make long-term investment decisions. And the second part is, which was more of the impact that we saw last year, is this concept of valuation. And, we have this in all assets. I mean, if you own property as an example, the reality is your property asset is exactly the same, give or take, if you do a bit of work to it every year. But sometimes there'll be periods when you'll hear that house prices are going up 10%, and there'll be years where you hear that house prices are going down 10%. But if you look at the actual asset itself, logically, that doesn't make any sense. And so valuation is something that's often linked to the perception of what is the value of a company. And that can create even more volatility in the medium term than just the daily volatility. I think you're on mute.
Sorry. A good example is when you own a business, as a personal business owner, if your revenue stream is not the same every year, so your EBITDA is not the same every year, you don't panic on your business. You're looking at your business in a long term, what you want to achieve in a long term. And at the end of the day, you're just investing in other companies in a portfolio, and you have, you should have a long-term goal, perhaps, that is underlined by what the portfolio is supposed to be doing. So second question is indexes. Can you explain why these kind of MSCI index? So, why does a fund need to track an index? Certain funds, let's say. What is that? What's the purpose of having that?
Like, I actually think, and I've been sort of a long-term user of indices of various different sorts, partly because it gives you an idea as to what are the components of a particular region or a particular sector, or even a particular investment style, if you want to get really narrow. So I think they'll have some benefits to a certain extent. The only problem is that it gives an investor the perception that everything within that index is worth investing in, and part of the game of investing, if I can call it the game, or part of the challenge of investing, is to have a discipline to ignore things that don't really matter to you. And so, yeah, on a given day, there's always a stock that's up 100% somewhere in the world. Now, if you focused on every stock that was doing that, you'd have a very difficult day, because there's 3,000 stocks in the MSCI All Country World Index. No human being would be capable of being able to analyze that many stocks. And so they provide a purpose. What we try to do is we use them as a starting point, but then we have a broader investment style. So we haven't really got onto the name of the fund yet, but the name of the fund is Carmignac Global Equity Compounders. And so just by that last word of this concept of compounders, we will ignore stocks that don't compound, or don't compound in terms of their profitability.
So compounding, could you explain that? Exactly what you're looking for when you're looking for compounders? Yeah,
so it's kind of the way we're taught about this when we're sort of at school and we're doing our education is often talking about compound of interest. So it's that concept of, like, if you have an investment and you earn an interest on it every year, then over time, the more you have invested, the better your returns will be. Now, from our perspective, we talk about it from a fundamental perspective, and for fundamentals, it's very similar to what you were just describing, which is how the business functions. So the business functions, you can have a business that 1 year does extraordinarily well, but then for the next 2 or 3 years does very, very poorly. And by doing really well, I mean that they may generate phenomenal profits, but then for the next 2 to 3 years, they make a loss. Now, what we look for is companies that have persistent and stable profits over time. So businesses that have what we call high and sustainable profitability. Mm-hmm. The compounding part is, what do they do about how they generate future growth? And anybody who runs a business will understand this, because it's what we call reinvestment. Yeah. Which is, what do you do with your profits? Do you take your profits and you pay them out in big dividends to the CEO and various different members of the board? Or do you look to invest those profits in new products and new services that will drive your future growth? Because to keep compounding growth rates is very, very difficult as a business. To grow, let's say this year, 15%, and grow your revenues again 15% the year after, and 15% is actually a very, very difficult thing to do unless you're constantly reinvesting. So the compounding impact is how your earnings essentially grow as a result of you reinvesting and compounding your growth rates.
So good capital deployment. So you're looking for companies that are clever in how they're deploying their capital.
100%, yeah. And actually, sometimes it's not necessarily. We look for the ones that are clever, but it's first of all trying to avoid doing the wrong thing. So taking on a ton of debt, because debt financing is low. So anybody, and we all know this is happening at the moment, but anybody in the last 10 years who basically took on a lot of debt because they wanted to take advantage of low interest rates, well, now they've got a problem because interest rates are rising. And so we avoid the type of companies that can't sustain their growth rates without using leverage. And we typically look for companies that have a really good track record of doing it. So I guess, you've seen, again, in the last couple of years, there's been this great boom in, I guess what people refer to it is growth stocks, but actually, it's the type of companies that they were growing, but they didn't actually have any growth. So that their revenues were growing really fast, but they never actually got to profitability.
Every day you see a new story about these companies, by the way, why they should be even more expensive, And it's just like, none of it's factual, none of it's creating actual revenue. It's just, in 2 years' time, this is going to happen. While today, it's still got minimal revenue.
Yeah, and that kind of links back to the this concept of the index and how we go from an index to where we are today. The first challenge we have is we have to make sure we do not invest in those type of companies. So
Yeah.
the index is there as a guide, and it acts as a filter for us, so that's to remove those companies and then focus on the ones that we think will be continue to grow, because it's just a strategy that they've been able to do over time.
So in the last few years, there's another topic that's just also been a hot topic. It's been something that you've been hearing a lot about. And I think it seems to be very close to what you do, and that is ESG. It's one of these concepts that's been thrown around a lot. And so it'd be great if you can explain what the environmental social governance in reality means and how it impacts what you do. And what's really interesting, I was listening to it was an analyst on a call, and the positive impact it could have actually on the growth of the company going forward. So maybe you'd like to just mention a couple of things on that.
Yeah, sure. I mean, just to give you a bit of history. One of the projects I worked on, this is prior to joining Carmignac, was to have a look at the return profile, which is another way of saying if you had invested, or the return profile of a strategy if you had focused on, let's say, environmentally focused stocks. So the E, S, and the G. The E is the environmental factors. The S is the social factors, which is more about how people treat their staff and employees and so on. And the final part, the G, is basically how a company's run from a board structure to just a discipline around management. And so I ran that strategy, and this was just over 10 years ago now, and nobody was interested. It's amazing. There was no appetite for this concept of investing in the right way, even though it was quite clear that the return profile was pretty good. I think now the world's moved, and I think it's probably because of various different factors, but that we all know of. But certainly from a demographic perspective, there is a massive cohort of investors that are coming forward that do actually care how you make a profit.
Well, I mean, there's that side to it. And also if you want to be a pure capitalist, it can impact your cost of capital. It could increase your sources of funding. If you turn around to the funders of this world, equity and debt, and say, look, we're producing whatever we're producing, we care about who works for us, and our energy footprint is down 30%. We're using this much less water, etc. And there's traceability in what we're doing. Then that's a great story for funding as well.
Yeah, I mean, it comes to, that's, I think, is what's shifted is, and as you rightly say, what's shifted is people have begun to realize that this can affect their bottom line. The way we do it is quite simple. There's two components. One is this kind of concept of, are there certain investments, in the same way we talked about the fundamental part earlier on. We said we don't want to own companies that just make a profit 1 year and then make a loss for 4 years, or we don't want to own companies that have never made a profit even though the share prices are going up. So that was the fundamental discipline. But we also don't want to invest in areas that we think may actually do harm to society. And it's always a controversial subject. But at the end of the day, like I mentioned earlier, there are 3,000 stocks in an index. And so we have the opportunity and the choice to make decisions that we think are right on behalf of our investors. And almost all of them agree in terms of what we're doing. So, for example, we won't invest in areas that are linked to weapons manufacturing, or we won't invest in sectors such as tobacco now, or anything that's in the sort of fossil fuel space, because it's just not in line with this sort of ultra long-term philosophy of we want to make sure we're doing things in the right way, as well as trying to make a profit. And it's one of the challenges that all investors have. I've got young kids. If I want to put money away for my children, does it make sense for that money to be invested in things that I don't think are great for society? And it's always a topic of debate, but that's how we tend to approach it. I want to make sure that the money of our clients is also in similar type investments. And you can see what's happening. I mean, actually, regulation is driving a lot of these changes as well. And so all fund managers are having to wake up, whether it's, does the company have a policy about human rights and how they treat their staff, to do they have even a policy internally about how they engage with their staff, so that they don't have their members of their staff leaving every 12 months. There are lots of things that are already happening.
Yeah, and it's really fascinating, because when you talk about environment, social impact, etc., people automatically think of green energy. They think of solar panels, etc. But probably a good example is textile industry, where there's more pressure for traceability. I think probably blockchain is going to be implemented first in textiles. So you can trace from where the cotton is grown, how much water has been used, which manufacturer produced it, all the way to who stitched the t-shirt or whatever, and how much energy is used. So textiles, for example, seeing a big impact with was it the Green Deal, European Green Deal?
Yeah.
So the spectrum's much bigger than just if it's, using renewable panels on the top of the factory roof. I mean, there's a much broader aspect to this.
100%. I mean, I think the biggest one from a macro perspective was basically what we saw last year, which was what people refer to as the Great Resignation. And the Great Resignation was all about people quitting jobs at the fastest rate in history. It was essentially saying to their bosses and their employers, and everybody has felt this in every industry. They're saying to your bosses, "I'm going to go somewhere else because I want to get a higher salary, and I don't really care what you do about it." Now, that was a massive wake-up call to all company owners, because they realized that there was a cost associated with having to rehire, re-educate their staff, and so, or to retrain the new staff that would come in. And so we, this concept of E, S, and G is now no longer an issue that people can ignore. In fact, it's almost becoming a primary reason to how people invest. So that's one aspect of it. We make sure we're not invested in the companies that we think from a long-term perspective are just not contributing positively to society. But the second part is to make sure that we do invest in companies that we do think actually from a product perspective, they're producing products that people and services that people actually want. And that's one thing that we've seen over the last, I guess it's maybe 5 to 10 years, is this, especially with the bull market in tech stocks, which may be coming to an end, let's see. But that bull market in sort of this new technology stocks, there's a lot of them were just producing products and services that people just didn't want. Yeah, people just were using. And so going back to the good old days of having things that are tangible that you can touch and products and services that people actually like to use, that's kind of where we tend to focus in terms of our ESG.
I actually know you got a couple of slides or something. Is there something at this point you want to share before about the fund, etc.? Before
let's dive. I mean, let's dive in. I guess. There's a couple of things that I will just highlight. If you
make sure you open the right tab now.
There we go. Yeah. So this is more just to reiterate a couple of themes in terms of how we think about it, and hopefully you can see that, right?
Yeah.
Yeah. So in terms of like a couple of the themes that we think about, we're thinking about companies with good long-term attractive prospects, and that's just basically this concept of high long-term profitability, not profitable 1 year, profitable over multiple years, but actually that they're using those profits to stimulate future growth. And then we've kind of just alluded to it a second ago. One of the ways that we make sure we're doing and investing in the right way over the long term is just making sure that we're not investing in all parts of the market. So there's two filtration processes. One fundamental, the other is more on the ethical side of things, as well as making sure that we target companies that have good products and services. It's basically why and I always say this, full disclosure. I have my personal investment wealth in this fund. In fact, all of my equity investment assets are in this particular fund. So is my wife's, and so are my children. This is the way that I think we should be thinking about investing in the long-term, good quality businesses that invest in the right spaces.
And do you think having a exclusion of certain sectors, do you think that impacts the returns? If I am purely driven by returns, and people are going to smoke, so I'm going to go and buy tobacco companies, so etc. Does that exclusion in the long term benefit you? Is it hardly any difference? You just feel better, or does it have a positive impact on what you do?
Well, it depends on how aggressive the exclusion is. And so with these exclusions, let's just take the weapons manufacturers and the fossil fuels, and actually you can add tobacco into that as well. We're talking about in total 8% of the market. So, you know, it's a very small part of the market. There are financial exclusions. So because we believe that
That's interesting. I didn't actually consider that from a actual overall market size, that it's only 8%.
It's relatively small. Now, actually, we need to be careful when we sort of talk about it in that way, because what can happen is, and we saw this basically last year when we had the start of the war in Ukraine with Russia, is some people started to question, well, what exposure have you got to this? And so it might seem relatively small, but actually 1% exposure to a theme that someone doesn't want to be exposed to when they find out there's a problem is a lot of exposure. And so that's why if you're investing in, let's say, the S&P 500, an ETF, and you then find out subsequently that you've basically been contributing in terms of your capital to parts of this market, people are often quite horrified. And so by leaving those out and excluding them in the first place, it's a relatively small part of the market. So it's not it doesn't have a big impact on our returns. But actually what has the biggest driver, and maybe I'll give you the third part in a second, the biggest driver of the returns is actually the financial criteria. To make money or to make profits in terms of returns in the longer term, you really need to invest in companies that have a very stable characteristics. And so that's the key components that you know, companies with high profitability that are reinvesting, that's where we get the biggest chunk and delivery of our returns from.
Okay. Unless there's more you want to mention on the fund, I'm sure you can talk hours about it, but should we touch?
Yeah, we can link it a little bit to the macro, I guess.
Yeah, because I mean, in my limited career, our sector is definitely led by older people, and you know, you get these characters we all follow and stuff. They've definitely been through, I'm sure Warren Buffett's seen a few more cycles than I have, but in hindsight, since 2008 to today, do you agree, like, we're actually maybe closing a page and starting a new chapter at this point?
Yeah, and in terms of I guess you're referring to this sort of broader
liquidity,
excess liquidity. Yeah,
I mean, I remember sitting at my desk on the trading desk in 2008 and seeing, and was it March, you know, just everything just go duk, 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 duk. I just had a couple of friends, one joined Lehman and one joined Bear Stearns. They're all doing very well now, but and early in the year before, and you just watching that period, and we suddenly started seeing terms and concepts that, you know, we never studied at school, you know, just pumping, just literally printing money, pumping it into the economy. And this zero rate where there's, you know, because I remember before that, just watching Greenspan, everyone would stop. What's he going to say? Number 25 rate cut. Okay, bye. And after that, this period of huge liquidity. And so what, do you agree with me? Do you not agree? It's like that period suddenly come to a close, and there's almost like a reset, normalization of how they should be a price to risk. And we're seeing that now normalize.
Yeah, look, I would say that last year was a very troubling year and difficult year for anybody who's invested in any asset classes that essentially were priced on a daily basis to manage, because, you know, that the unwind, maybe it's not complete unwind, but the reset of where we were relative to where we are today, which is basically we've gone from a very low interest rate regime, almost unthinkably low interest regime, back to what we would in the old days call relatively normal. Although when you look around Europe, you're still able to buy government bonds in certain parts of Europe at yields of 4.5%, which is nowhere near the levels of risk premium that you'd expect for certain countries. And so we're not quite fully there. But I mean, I think there were two parts of last year. One of them was that reset, which was kind of a painful adjustment. But actually, do you know what? I genuinely believe a lot of people were almost relieved, because it was like 10 years of madness almost, where you could borrow and buy anything for nothing, and you could create anything at no cost, and there'd be no cost of failure. And so getting back to normal allows you to go into the sort of newer world where, yes, if it's a bad investment, you will suffer for it. You can't just build 15 factories with nobody there and not have a cost associated with it. And so, you know, that's one of the things I think has changed. But I mean, there's a sort of argument at the moment that we're changing regimes, and I like to use the analogy of music. And you know, certainly when I was younger, we used to have cassettes, and then it went to CDs, and then I even remember the mini disc players. And now, I'm sure there was a period, if you remember, that we were using MP3s. And now
I remember the first time a colleague of mine, he was from our New York office, and he walked into our office with this small little thing. And I was just like, wow, you've got 60 songs on that? And, you know, it was definitely unheard of. Yeah, that was a funny time.
Well, but then if you then transfer that forward to our kids, they will never see any of those. And so, you know, what I try to say is they're all different regimes, but the underlying is you're still listening to music. And so whatever regime we're going into right now, the underlying will be the companies have to produce earnings and profits for their share prices to go higher. Even now, they may do it by different means, and we may see slightly different companies lead us forward that maybe led us in the last decade. But as long as we're focused on the companies that are profitable and able to lead us into this next regime, then it's not going to be a problem. And so that's why I'm always very careful. But I mean, there are lots of other things that are a little bit more shorter term. You know, the inflation spike, the end of the supply chain issues. I mean, there's all these different things that people are trying to get their heads around before they make the decision that the world has indeed changed. Because we have up-teen evidence now that it may be that lots of these things that we saw, the inflation spikes, they may have just been a function of shutting down the global economy for a year and everybody scrambling to buy products and services that weren't being made at the same time. And then almost for a year, having almost an unprecedented amount of demand for those products and services at a time when normally, if you're in a recession, there's no demand. And so we know that how this is all played out, and we can see how it's starting to unwind, which is you've got too much of everything. And so before I'm throwing my hat in and saying, hey, we're moving into a new regime, I want to see what it looks like when people start to adjust to that. Actually, we're going back to normal. People are starting to work again. Factories are reopening. We may start to go back to more just-in-time production as opposed to people creating and ordering 2 times the products that they need for.
Well, there was no cost for the inventory. That's another strange thing. There was no cost of keeping inventory. You know, it was maybe a better way than for them, but relatively speaking, yeah. So,
and that adjustment, I think will take is, you know, we're probably. I mean, I'm only saying that because I'm watching the inflation numbers, and the inflation numbers are quite key, and that was one of the reasons we weren't able to deliver the type of returns that our investors would have expected last year, is because when you have high levels of inflation and higher interest rates, companies that trade on higher valuations, and that typically tends to be the type of companies that we own because they're really good businesses. I'm not talking about the super high multiple, or not even an earnings multiple, but I'm talking about, and by multiple I just mean valuation. I'm talking about really good, solid businesses. Their valuations were really cut last year, and that's because people were worried about inflation and interest rates. So if things normalize, inflation starts to come down because we're going back to normal, and then all of a sudden the anxiety about higher interest rates starts to come down as well. And that's a very, very potentially good environment for us.
So to take that one step further, let's say, in layman's terms and simply put, let's say the anxiety of inflation, we could argue, is behind us for now, at least. You know, it seems to be coming down. All indicators are showing, you know, that the US economy is slowing down. The inflation numbers coming down. So from a fund manager, equity fund manager perspective, how do you see, if you had to sum up to 2023, what are the key things you're looking for example, where you would say, okay, you know, the recession is the key thing, for example. Is there going to be a big recession? How the market's going to react to that? Do you believe it's one step at a time at the moment, rather than second guess what's going to happen in the next few months? Because there's quite a lot of scenarios out there when you read research, and you think to yourself somehow, okay, this is becoming a little bit too binary in my mind, what people are saying.
Yeah, so I'll show you maybe a slide in a second to just illustrate the two issues. One of them is this concept of how do you invest in a period where economic growth is let's say not as strong as we would like it to be. So I'll talk you through how we do that within the fund. And then there's is this 2023 environment going to be more advantageous or less advantageous to our style of investing? And I think if I just look back to last year, I mentioned earlier on that inflation and the higher interest rates were a problem for companies. We've had higher valuations, even though the companies were functioning and just as profitable as they have been previously. What it also happened last year is when you have inflation, we all know and felt this. Every single company that exists, from your barbershops, your taxi drivers to your local restaurants, were raising prices. Everybody. So everybody's revenues last year went up. And so one of the risks as inflation starts to come down, and all I'm talking about is the pace, is that the ability to raise prices for the vast majority of people is about to disappear. So everybody got a lift last year. This year, fewer and fewer people will be. And actually, you've started to see it. So there's certain companies, we had it in the auto sector just recently, that are starting to cut prices. Their input costs are going down. Therefore, they can start to reduce. So revenues could come down. Now, that makes it a challenge in that we have to try and make sure we find companies that are able to grow their revenues and continue to maintain their profits. And that's where we think we're quite well positioned, because we've got.
Sorry, but at that point, how long are you? Because this is something we were kind of discussing a little earlier today. So let's say you're looking at an automotive maker, and at today's interest rates, you build a kind of a valuation outlook on the company in today's. How much importance would you give on its drop in demand now, rather than long-term costs of capital and the financial health of the company, compared to okay, for 6 months it might sell less cars, but in the long term the guys have got a great foundation, and come when demand picks up, these guys are going to do well. So how would you place the importance, or are they just as important?
So they're just as important, I think. Well, let me show you this slide, and you'll see what I mean. So I'm just going to show you how we do it with our fund. Here we go. So let's share. Here we go. Okay, so we have a process in our fund, which essentially it takes. We always invest in certain types of companies. So I mentioned before that we invest in high quality businesses, highly profitable, reinvest. But, and the most important but, is some of these type of stocks are very, very sensitive to the world around them, and some of them are not. So let's split them in half. The ones that are sensitive to the world around them, where demand may fall when the economy starts to slow, are what we call cyclicals. And the names that are what we call more defensive are the type of companies that will do well in all environments, because they sell products and services that you need and use all the time. So to give you an example of one, you've just mentioned an auto manufacturer or the auto sector. I would class that as a cyclical, because when times are tough, you don't need to buy a car. And
but but if you're looking at a detergent manufacturer or shampoo manufacturer, everyone always buys shampoo.
100%. So what you typically tend to see happen, you can see there's a little star on the chart there, but when we progress, and we've been coming down basically now for about 18 months. So when we progress from phase 2, which is what we call the scarce growth phase. So you've got growth, but it's starting to slow. And then we head towards what we refer to as capital preservation. That's when things get a little bit tougher, and that's phase 3. What typically happens is the more defensive parts of the market will do a lot better, because the demand for their products and services will remain relatively resilient versus others. And I think that's kind of where we are today. So what we do within the fund is that we make sure that as the cycle is going through these phases, that we make sure we have adequate or inadequate in terms of we make sure we're underweight sectors which are really exposed to the cycle. And if you think back to the last financial crisis, and I don't think we're in anything like that, but the people that suffered the most were those who had too economically sensitive assets in their portfolio. So if you had a lot of bank stocks, or if you had a lot of industrial stocks, which are very, very what we call GDP sensitive, the world around them dictates basically the demand for their products and services, then you tend to suffer. And so what we try to do is to make sure we avoid those companies until the sky is clear and we hit this sort of phase 4, this recovery phase, when things start to look a little bit better.
Actually, so that's really interesting, because it seems you are saying that the portfolio is not static, and that there are adjustments made according to the macroeconomic conditions that surround us.
100%. So, and we make those adjustments. We make those adjustments with just the sizing of the stock. So, let's just think of, let's say you had 2 companies in your portfolio. One of them, and you love both of the businesses. They're both phenomenal businesses. They're both growing. They're both highly profitable. They're both reinvesting. But one of them is a bit more sensitive to the macro environment, the world around us, and the other one isn't. Well, let's say you had a choice of the two companies, 50% in one and 50% in the other. Well, all we're doing is essentially saying, well, actually, if times are going to get tougher, and we think the demand for products and services may start to wane because interest rates are high, growth is starting to slow, inflation is starting to come down, pricing may be becoming difficult, then we'll have a much smaller exposure to the ones that are more sensitive and a much bigger exposure to the ones that are less sensitive. Same stocks,